The wire transfer went through at 2:47 p.m. on a Tuesday, $340,000. Marcus Chen refreshed his dashboard 17 times in the next 4 minutes. The balance didn't change. He called the support line, automated message. He called again, same recording. Third attempt, disconnected before the first ring. That's when he opened the regulatory database. The company didn't exist. It never had. But 6 weeks earlier, Marcus had sat in a conference room in Palo Alto with 3 former Google engineers, a Stanford professor, and documentation so thorough it included SEC filing numbers. How do you lose everything to something that was never real? Marcus Chen wasn't supposed to fall for anything. 15 years at major tech companies, back-end infrastructure, systems design, the kind of engineer who spots edge cases other people miss. He'd built fraud detection algorithms. He'd reviewed thousands of lines of security code. He understood distributed systems, cryptographic signatures, trust protocols. He was the person his friends asked before making big decisions. He had $340,000 in savings, money from stock options, years of discipline, no debt. He was 42. He wanted his money to work harder than a savings account, but he wasn't reckless. He'd seen the crypto crashes, the NFT disasters, the startups that evaporated. Marcus wanted something different. Something regulated, transparent, boring. So when he first heard about Archway Capital, he almost ignored it completely. It came up during lunch, from David, a director of engineering, someone Marcus had worked with for 3 years. David mentioned he'd moved a significant portion of his portfolio into a structured credit fund. Marcus asked which one. Archway Capital, institutional grade fixed income. They're opening limited slots to accredited investors. Marcus had never heard of it. Neither had I, David said, but I spent 2 months digging into it. Former Goldman partners, real SEC filings, audited returns. I'm getting 12% annually. 12% wasn't insane. It was just better than bonds. David sent him a link that night. The website was clean, professional, nothing flashy. The leadership page showed 3 founders. All had LinkedIn profiles. Stanford MBA, Goldman Sachs, Treasury Risk Management. There was a 47-page investor prospectus. Marcus read all of it. It outlined the fund's strategy, purchasing corporate debt instruments, structuring them into tranches, selling higher-risk portions to hedge funds, keeping the secured senior debt. Boring, mechanical. The returns were consistent, 11 to 13% annually, audited by a firm Marcus had heard of. There were risk disclosures, pages of them, market risk, credit risk, liquidity constraints. Everything felt meticulous. Marcus did what he always did. He checked. He searched for the SEC registration number. It appeared in the Edgar database, filed correctly, dated 18 months prior. He looked up the audit firm, real company, Delaware office. He read reviews, found a Trustpilot page with 87 reviews, mostly positive. He searched for red flags. Archway Capital scam. Nothing. He ran the founders' names through LinkedIn. It all matched. He found a press release from 8 months ago. Financial news site had covered their Series B fundraising. Marcus spent 11 hours across 3 weeks researching. He found nothing wrong. The call was scheduled through their investor portal. 2 days later, he received an invitation to a video conference. Not a sales pitch, an informational session. There were 7 people on the call, all accredited investors, all asking detailed questions. The fund manager was Richard Keller, mid-50s, calm, technical. He walked through the portfolio composition, answered questions about default rates, collateral structures, redemption terms. Someone asked about liquidity. Quarterly redemption windows, Richard said, standard for this asset class. We ask for 30 days notice to avoid disrupting the portfolio. Someone else asked about risk. There's always risk. This is debt, senior secured debt. If a borrower defaults, we're first in line. Our historical loss rate is under 0.8%. Marcus asked about the audit process. Richard pulled up a document, shared his screen. Audit firm letterhead, signed opinion, clean. Marcus asked if he could speak with the auditors directly. Absolutely, we encourage due diligence. The call lasted 90 minutes. No pressure, no urgency. At the end, Richard said, "If you're interested, we'll send the subscription documents. Take your time. Have your attorney review them." Marcus liked that. That's what scams didn't do. This felt professional, institutional. 3 days later, the documents arrived. 63 pages. Marcus read every page, highlighted sections, made notes, cross-referenced terms. Everything matched industry standards. The fee structure was transparent. The redemption terms were clear. The risk disclosures were extensive. Marcus sent them to a lawyer friend. 2 days later, it's standard. If the company is real, the structure is legitimate. If. That word stuck with Marcus, so he made one final check. He called the phone number listed on the SEC filing. A woman answered. "Archway Capital, how can I help you?" Professional, not rushed. Marcus asked a question about redemption terms, deliberately complex. She put him on hold. 30 seconds later, a different person picked up. "This is Stephen in operations. I understand you have a question about redemptions." Stephen answered accurately, matched the documents, added detail. Marcus hung up. He'd checked everything, every verification point confirmed. Marcus felt certainty. He opened his bank's wire transfer portal. Account name, Archway Capital Management LLC, Bank, Northern Trust. He typed the amount, $340,000. His hand hovered over the confirm button. This was everything, his entire savings, 15 years of discipline. But he'd done the work. He'd verified. He pressed confirm. Within 18 hours, his dashboard updated. $340,000. Confirmed. It felt like relief, like validation. He'd done everything right. For the first 4 weeks, everything worked. Marcus received weekly updates. His balance ticked upward. In week 5, he received a notification. Interest payment processed. $3,200 deposited to linked account. He checked his bank. The deposit was there. Real money. That was the moment Marcus stopped checking, because it worked. Because when something pays you, it becomes real. He told 2 friends about it. One invested $50,000. Marcus felt confident, validated. In week 8, he received an email. Scheduled maintenance on investor portal. Expected downtime, 24-48 hours. Normal. Marcus had seen this with every financial platform. 48 hours passed. The portal didn't come back online. Marcus tried logging in. Error message. He waited another day. Still down. He sent an email to support. No response. He tried the website. Gone. 404 error. Marcus felt his chest tighten. He called the phone number. Disconnected. The number you have dialed is not in service. Marcus opened LinkedIn. He searched for Richard Keller. Profile removed. He searched for the other founders. Gone. Marcus opened the SEC database. His hands were shaking. He entered the registration number. The filing existed. He clicked it. But the company name was different. Not Archway Capital. Alpine Credit Solutions. Dissolved in 2019. The registration number was real, but it belonged to a different company. A dead company. A shell closed 6 years ago. Someone had copied the number, changed the details, posted it on a fake SEC page. The audit firm was real. Marcus called them. "I need to verify an engagement. Archway Capital Management. We have no record of that entity, but I have your signed audit opinion." They called back an hour later. "This is a forgery. The signature is copied from a different engagement. The content is fabricated." The Trustpilot reviews, all posted within a 6-week window. Same writing style. Generated. Fabricated. The press release? a fake news site designed to appear in search results. The video call? The 7 investors weren't asking to learn, they were demonstrating expertise, making Marcus feel like he was among peers. Scripted. Richard Keller was someone reading from a script in a rented office. The $200 deposit? Marcus's own money. They'd taken his $340,000, sent back $200. Because once you see a return, you stop questioning. That $200 bought them 8 more weeks. Where Marcus didn't look closer, where he told friends, the entire system was a fabrication. But it wasn't random. It was designed for someone exactly like Marcus, someone who checks, someone who verifies, someone who trusts systems. Because the trap wasn't hidden in the details, it was hidden in the verification itself. The things Marcus checked, the SEC filing, the audit firm, the LinkedIn profiles, were all real, just not connected. The registration number belonged to a different company. The audit firm existed, but never worked with Archway. The founders' profiles were stolen identities. Every single piece was legitimate. The fabrication was in the assembly. And because Marcus verified each piece individually, he never saw that they didn't connect. He trusted the process, and the process was the trap. The sophistication wasn't in creating something from nothing. It was in arranging real things into something false. It was in knowing that people like Marcus verify and then stop. Because once verification succeeds, suspicion ends. That's where the invisible trap lives. Not in what's hidden, in what's confirmed. Marcus sat in his apartment for 4 hours. He didn't move. He just stared at the screen. $340,000. Gone. Transferred willingly. After weeks of research, he'd done everything right, and that was the problem. Everything looked real because it was real, just not real together. A rented answering service. Probably $200 a month. Actors paid maybe $100 each. His own money sent back to stop him from looking deeper. The whole system cost maybe $15,000 to build. They stole $340,000 from him. Marcus reported it, filed with the FBI, the SEC, the FTC. These operations are nearly impossible to trace. He asked if they'd recover anything. We'll add it to the case file. That was 6 months ago. Marcus still checks his email. Nothing. This wasn't stupidity. Marcus wasn't naive. He wasn't greedy. He wasn't careless, he was rational, methodical, careful. And that's exactly why it worked. Because the trap wasn't designed for reckless people. It was designed for people who check, people who verify, people who trust the process. The invisible trap isn't the lie. It's the verification that makes you stop looking. Marcus had checked the SEC database. He'd verified the audit firm. He'd cross-referenced LinkedIn profiles. He'd had a lawyer review the documents. And because each piece checked out individually, he never questioned whether they connected. He never asked the question that would have saved him. Not, is this real, but why does this need to exist? If a fund this legitimate needed to recruit through private referrals, why? Real opportunities don't have availability. They have waiting lists. But Marcus never asked, because everything else checked out. This is what makes certain deceptions invisible. They don't hide from scrutiny. They survive it. They welcome it. They're built knowing you'll verify, knowing that once you confirm the details, you'll stop asking bigger questions. Marcus trusted the SEC database, so they gave him a real SEC number, just not connected to them. Marcus trusted audit firms, so they forged an opinion. Marcus trusted LinkedIn, so they stole real profiles. They didn't create fake credentials, they stole real ones. The invisible trap lives in that gap, between what you verify and what you assume. Marcus verified the pieces. He assumed they formed a whole. That assumption cost him everything. He still works in Silicon Valley. His colleagues don't know. He told 3 people, his brother, his friend, a therapist. The shame isn't just financial, it's intellectual. Marcus learned something in the 6 months since. The trap wasn't personal. It was about a system built to defeat verification, and those systems exist everywhere. They're built the same way, piece by piece. Everything checks out, until you step back and see the pieces don't connect. Now, when someone shows Marcus something that looks perfect, he doesn't check the details first. He asks why it needs to look perfect. Because perfect is expensive. Perfect takes effort. That question reveals invisible traps. Not, is this real? But, why does this need to convince me it's real? Because the invisible traps aren't hidden in what's wrong. They're hidden in what's right, in what's verified. Marcus lost $340,000. The most dangerous traps aren't the ones you can't see. They're the ones you think you've already checked, because that's when you stop looking, and that's when the trap closes. Not in what you missed, in what you verified and moved past. That's the invisible trap, not hidden, confirmed.